Let's get into some news really quickly. Netflix, Variety is reporting that these new movies are going to come out every single week in 2021. That's 70 movies in a year. Like Idris Elba, Jennifer Lawrence, The Rock, Ryan Reynolds, so many more stars.
You heard that right, everyone. Netflix is planning to release 70 new movies on their platform throughout 2021, which is more than one new movie every single week. And that is close to 50 more movies than their next competitor in the streaming wars. So right now, Netflix is still the leader in the streaming world, and they have more than 200 million paid subscribers. And the company also shared some great financial news, stating that they will be cash flow positive at the end of 2021, which is incredible for this business that has been burning a ton of cash over the past 5 to 8 years. And the company just shared their latest earnings, giving investors a ton of confidence in their business, and their share price grew close to 17% in one single day. So we're going to discuss if Netflix is still a buy at this level right now, go over how the company is expected to grow their content, their subscribers, and the overall platform over the next 3 to 5 years, and if this company can maintain its market leader position in the streaming world. So if you're new to the channel, everyone, I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and sell, and discussing any major market news or headlines. So please hit the like button, subscribe for daily videos about the stock market, and in this video, we're going to go over Netflix and the reasons why this company can be much larger over the next 5 to 10 years compared to where they are today. So when we discuss Netflix, we have to talk about the huge amount of content they are releasing over this year. By far, they are way ahead of their competition, releasing 70 new movies compared to Disney, who is in second place with 22 planned releases in 2021. So Netflix is really going for the volume in their content that they're putting out. And I love that strategy for Netflix, and I'm not the only one. I'm going to share with you a clip from Gary Vaynerchuk in that same interview from Drew Barrymore, where he gives his opinion on the mass amount of content Netflix is releasing over the next few months.
But I think this quantity execution by Netflix is brilliant. I think that in Hollywood and in general in creative land, we demonize quantity. We're like, what about quality? Well, quality is subjective. You either like it or you don't. But quantity is not subjective. So while Netflix puts out all these movies and their competitors put out far less, it gives Netflix many more at-bats to hit the home run that, let's say, a Queen's Gambit was. And so I think quantity is demonized in creative landscapes and should not in an internet infrastructure world.
And I absolutely agree with everything Gary Vee said. The fact that Netflix is going to produce more than 3 times the amount of new movies as their next competitor over this year, I think will give them so much opportunity to grow their subscriber base and attract a much wider audience. And with Netflix, I think this will allow them to retain their current audience much better than their other competitors. Because if you are subscribed to a streaming service and that new content isn't coming out frequently, you're going to get bored, and it's a higher potential for you unsubscribing and canceling your membership. But if Netflix continues to pound out content, continues to release new and attractive items to their screens, even if not all of them are successes, that new content will always keep people wondering what's next, what's coming out next week, next month, and they always understand and know in their brain that Netflix is never going to get boring because there's going to be a continuous influx of new content coming in every few weeks. And I do believe that strategy is going to allow Netflix to maintain and grow the over 200 million paying members they have on their service right now. And if we take a look at Netflix, on their latest report, they announced over 8.5 million new member subscriptions, bringing the grand total to over 203 million members from all around the world. And this number is only expected to grow over the next decade. And if we take a look at an analyst prediction for 2030, they expect Netflix subscribers to be between 475 million and 525 million over the next 9 years by 2030. And that huge increase in total subscribers is going to drive the top line even higher. And that represents around a 10% annual increase from the midpoint at around 2025. And overall, this should keep Netflix's revenue growing at a double-digit rate, plus any increases in price as time goes on. And another key component to Netflix's long-term growth is the increase in their operating margin. Because they're plowing a ton of money, billions of dollars each and every year into their content, over the past 5 years, their operating margin has been in the single digits. But over the long term, they plan to bump that up. And by year end 2020, like we just got from the report, they were predicting 16% operating margin with plans to improve its profitability over the long term. And I do believe as their content continues to grow at scale, they will be able to drive costs down, bringing up their operating margin over the long term. And from their latest earnings release, the company shared some very positive news. And they announced that after 2021, the company expects to be cash flow positive. Throughout 2020, they expect to be neutral with regard to cash flows, but after that, in 2022 and beyond, they expect to post positive cash flow numbers and do plan eventually on doing some share buybacks to reward investors with some form of capital. And of course, share buybacks haven't been done in Netflix since 2011, which was the last time the company was actually cash flow positive. So over the past 9 to 10 years, they have been burning a ton of cash in order to grow their content and expand the platform. And this is a very strong sign because after 2021, they expect to no longer need external financing to fund their operation, which was ending a decade-long trend for their business. And that fact that they were burning a ton of capital just to remain operational and fund their content was really scaring away a ton of investors. So the fact that this new announcement says that they're planning to be cash flow positive over the next 12 to 24 months, I believe is what really led to the massive 17% increase we saw in Netflix stock over the past trading day. If we take a longer term perspective for Netflix, the company has grown by more than 47% on the 1 year chart, and over the past 5 years, the company's up 365%. So when people think about Netflix, they are included in the FANG stocks, the big tech companies that drive the market even higher. But compared to Facebook, Apple, Amazon, and Google, Netflix is by far the smallest. All those other companies are worth over $1 trillion, and Netflix's current market cap is only $220 billion. So the company is still very small compared to the other tech names that they are associated with. And if you want to get into Netflix right now, they are trading at a forward PE of 55, which of course compared to traditional blue chip dividend paying metrics, that is extremely high. But compared to some other tech names that have exploded this year, it is actually much more reasonable than people think. So now to close out this video, we're going to go over some future growth projections for the business by many different analysts and see what they're expecting for the company over the long term. And then we're going to dive in to Netflix's financial statements. All the big tech names, all the other FANG companies have beautiful, solid financials with very little risk. And we're going to determine if Netflix is still a buy at this all-time high and if their financials are warranting a $220 billion market cap. So now if we jump over to Simply Wall Street, they are predicting around 26 to 27% annual earnings growth from Netflix over the next 3 years. And they have a beautiful chart showing the annual expected growth in revenue and earnings over the next 5 years in the future. So if we compare from where we are right now, the company posts around $24 billion of annual revenue with around $2.8 billion of net income. But by the end of 2025, so about 4 years from where we are today, we are expecting close to $50 billion of revenue and over $11 billion of net income over the next 5 years. So they're expecting Netflix's top line to more than double and their earnings to go 5x in only a matter of 4 years. And for a large cap company like Netflix with a $200 billion market cap, I think this can send the share price way higher than where they are today if they can achieve these numbers. And if their subscribers continue to grow, they continue to put out new content and gradually increase the price of their service, I think these numbers are very achievable over the next 4 to 5 years. And to get a greater perspective, if we take a look at a different analyst report, a survey of 39 different analysts are forecasting massive growth for Netflix next year at over 46%. And now if we take a look at what Yahoo Finance shows, over the next 5 years, Netflix is expected to grow at 45% per year for the next 5 years in the future. So that's an insane amount of growth from this huge tech company. And I think this company as a whole, if they continue to grow their subscribers, if their content strategy this year works out very well, and they can actually attract new users to the platform, these numbers are very achievable. And now if we take a look at their financial statements, let's paint a picture of how the company has grown over the past few years. We already take a look at how the company is expected to grow in the future, but how have they been growing in the past? We can see back in 2016 year end, they posted around $8.8 billion of top line revenue. And in a matter of 4 to 5 years, they have now grown it to around 25 billion over the trailing 12 months. And if we take a look at their bottom line, that continues to grow at an exponential rate year over year as well, with over 2.7 billion of total net income over the past year. So they are trending in the right direction, and I do understand why they are associated with the big players like an Apple, an Amazon, and a Facebook. All of their top line revenue and net income are growing at an exponential rate. But if we take a look at their balance sheet, currently the company has around $8.2 billion of cash on hand, with around 9.7 billion of total current assets. And if we compare that to their total current liabilities of 7.8 billion, they do actually have a ton of total current liabilities due over this year. They do have enough total current assets right now to deal with it, with still over $2 billion left over, but as a whole, this ratio isn't as strong as I would like it. A current ratio at around 1.2 to 1.3 for a major tech company is actually low. In the overall market, that would be considered strong, but a lot of tech names have current ratios above 2 or 3 at this level right now. And the company is around $40 billion of total assets, but a majority of that, of course, is intangibles. The content they own is an intangible asset. Of course, it can be sold, but it's not physical, you can't touch it. It is more of a digital asset. And although it is given a value on the financial statements, I don't trust that too much. Because if Netflix was ever in need and had to sell that content in order to fund operations and keep the business alive, no one would be paying full price. And I'm sure they wouldn't actually be able to achieve over $25 billion of cash flow for their content. But overall, the balance sheet still does look strong. I'm not worried about the short-term financial position. And from their latest earnings report, the CFO announced that they have no liquidity issues and will have no problem paying off their short-term debt, which does bring me a ton of confidence. And if we take a look on their balance sheet, total equity continues to grow year over year, which is a great sign for a business, and that's really what we want to see. So as a whole, Netflix's balance sheet isn't bad. It's not the strongest, but in no way is it terrible. Total equity continues to grow. Their current ratio is okay at 1.3 at this level. They will be able to pay off their short-term debt with ease, and the income statement and the net income continues to grow at a massive rate. So as a whole, Netflix has seen some beautiful long-term growth, and over the past trading session, the company grew by more than 17%. I do like Netflix right now. People are going to think I'm crazy for saying this, but I like Netflix yesterday, I like it even more today after this presentation, and I still like Netflix even at this price level. Of course, I would like to see it dip to get in at a more efficient rate, but even if you have to buy into Netflix now between $580 and $600, I believe over the long term, this company will still be much larger in 3, 5, 10 years down the road. I think our world will need more than one streaming platform, no matter what. Even if other competitors like Disney and HBO do gain some more market share, I think as a whole, no one will ever be confined to one single platform. So I think companies like Netflix are always going to be around. I think they're the leader in the industry. They're kind of the blue chip dividend paying name of the growth in streaming. They're the well-established company, their operations are worldwide, and they've proven that they can succeed at a large scale. So I think the fact that this new content is going to continue to hit the platform at a fast rate, I think they're actually going to be able to maintain their current subscribers of over 200 million people because of the new content and attract even more. They're going to get their margins up, they're going to make more money, they're going to become cash flow positive, and a lot is actually going well for Netflix because of the pandemic and for many years in the future. And I think the way we consume entertainment and media has been changed forever. Although I do think movie theaters are going to come back, they're never going to be as big as they once were, and watching content at home from your own devices on your own couch is going to be a bigger part of our lives going forward than ever before. So although it's at an all-time high, people are going to think I'm crazy in the comments for saying this. In my personal opinion, I like Netflix here. I will like it tomorrow. I'll like it the day after. And as a whole, I think this company is going to be much larger in the future than where they are today. And that is how I decide if I'm buying a company. I like the financials. I think their debt load is still large, but very manageable. The fact that they're going to be cash flow positive and not going to have to rely on external financing anymore is a huge sign for investors who dig into financial statements like I do. And as a whole, I like the company, I like the name, I like everything about it. That was my quick opinion on Netflix. So please let me know what you think in the comments down below. Share your thoughts. I love having conversations, and I appreciate you watching, and see you in tomorrow's video.